Hello and welcome to How to Invest. In today's video, we're going to be talking about 5 undervalued stocks in a market that is at all-time highs. First off, we're just going to look at the S&P really quickly, which is near all-time highs, the NASDAQ also near all-time highs, and the Dow Jones, which is also at all-time highs. The VIX is currently in a massive crunch going towards one-year lows as well. So in a market like this, many investors are scared for the next pullback. They're like, what's going to happen? The market is obviously near these all-time highs. You have the S&P 500's PE ratio at elevated historical levels, so high compared to historical levels for PE ratios. So what do you do as an investor in a market like this? Well, first off, I just want to start by saying, even though the S&P is at all-time highs, does not mean it will not continue to make new all-time highs after new all-time highs. This is consistently the case. If we go back to the S&P 500 and we go look at the 5-year, so this is a all-time high here before a pullback. And after this, you have the market starting to come up again. And right here, it hits all-time highs. And after this, it continued to hit new all-time high, new all-time high, new all-time high, new all-time high for months and months after it hit its first original all-time high. So just because the market is at an all-time high does not mean that it needs to pull back. This is often the case. The market continues to make new all-time high after new all-time high. Regardless of this, I think as an investor, you can continue to make incredible asymmetric bets in companies that are undervalued and have amazing opportunity in front of them. So that's what we're talking about today. We're going to talk about 6 companies that are actually cheap in this overpriced market and have amazing prospects in front of them. The last 2 things that I want to talk about in terms of the overall market before we go into the 6 undervalued stocks is, first off, the Fear and Greed Index. It is actually at a 50, which indicates that the market is not overly greedy at the moment. So it's in a neutral. Typically, the best time to buy is when it's an extreme fear. We want to be contrary investors. When the market is greedy, we want to be fearful. When the market is fearful, we want to be greedy. So currently it's in the neutral position, and there is actually a lot more room for the market to get more greedy in the future. And so I think we're far away from being that fearful contrarian investor point where the market's super greedy and we need to start actually being fearful. I think there's a lot of room for the market to continue to move up as a whole. Obviously, we cannot predict the future. Any black swan event could completely change the outlook. And that's why you need to continue to stay up to date with the news and such. The second thing to look at is the AAII investor sentiment. And this shows that the majority of investors are still bearish. So we have lots and lots of room for these investors to switch over to the bullish side. So with the majority of investors still on this bearish side, that means there's tons of capital to still be deployed. On top of that, money market accounts are at all-time highs. So there is tons and tons of cash on the sideline that can be poured into this market, even though it's at all-time highs, because people are still bearish. This has been called one of the most hated rallies in stock market history. So these people are not expecting the market to continue to go up. There's a good chance that it will continue to go up, especially with rate cuts in the near-term outlook. So you could see a lot more cash continue to be poured into the market, and this market continue to melt up. The first stock we're going to talk about today is Lemonade. It is still below its IPO price even 5 years later. So this is a very beaten down stock, very far off of its own all-time highs. All-time highs around 188 is the all-time high, and it's currently trading at $49.40 a share. And this, I want to talk a little bit more about why we view it as underpriced. So the 2 reasons we currently believe Lemonade is still undervalued, even at its current stock price, is 1, a acceleration in IFP growth. So most stocks' top line is their revenue. For insurance companies, it's actually their enforced premium. So there's enforced premium and then there's revenue underneath that. So currently, Lemonade's enforced premium is growing at 29% year over year and accelerating. We believe this acceleration in IFP is going to continue as management has guided. And on top of that, we also have to look at the next line down, which is revenue. So revenue, they are currently reinsuring 55% as of July 1st. And July 1st, they actually dropped the reinsurance. So that's the amount of IFP that doesn't fall to the next line into the revenue line. And that's dropping from 55% to 20%. So that means of the current in-force premium, 35% more IFP is going to drop to the revenue line. So that is a significant increase in revenue on top of IFP continuing to grow at 30% and accelerating. If we take a look at Lemonade's price to sales ratio, which is currently at 6, we can see that get cut in half over the next year. Something like 80 to 100% revenue growth over the next year is what we are projecting for Lemonade. So this price to sales ratio is going to drop very, very quickly. On top of that, they are projecting to get to profitability in 2027. If you want to learn more about Lemonade, make sure to watch our full deep dive on Lemonade. The next stock I want to talk about is UiPath. And this is actually the first time we've mentioned UiPath on the channel. It's a new one that we are investing in now. We've been tracking it for over a year, and currently at its current valuation, it has a 4 price to sales, which is crazy for this company. It has over an 80% gross margin with 108% dollar retention rate, which means on average, not only do the customers they currently have all stay, they spend an additional 8% annually, as well as bringing in new customers. And that's just for their current product. This is why UiPath is such an undervalued stock. They are trading cheap for their current business, but on top of that, they just came out with a new software called Maestro, which is a competitor to Palantir Foundry and AIP. We're talking about agentic automation. So currently, you can buy UiPath for their robotic process automation product and get their agentic automation product for free and all of the upside that comes with that. On top of that, they are trading at pretty much all-time lows in their historical stock price trend. So they are just at a really, really great buy position at this moment. This stock is currently rated as kind of a dying company by the stock market. Something with 80% gross margin should definitely not be trading at a 4 price to sales ratio. So if the market wakes up and realizes that UiPath is actually a massive competitor to Palantir, this company could get completely re-rated. On top of that, you have accelerating revenue growth as this new product catches on. We've already seen what's happened to Palantir's evaluation. Now, I don't believe it will get as crazy as this is the competition and not viewed as a monopoly like Palantir currently is, but you could see a massive re-rating in UiPath stocks, multiples. On top of that, their agentic automation platform has already shown promise with customers, saving one client 18,000 man hours through automation. And Geisinger, a massive healthcare provider, has been saved over $100 million through automation using UiPath's agentic automation product. If you're enjoying this video and finding it informational, make sure to like and subscribe for more deep dives like this in the future. Next, we're talking about Shift4. Jarek Eisenman was the CEO and recently stepped down from the CEO position, but is still on the board of this company. And if we look at the latest investor day, they are guiding a 3-year CAGR annualized of 30% revenue growth. And they're trading at a 30 PE ratio. So Peter Lynch's rule of thumb, back of the napkin math rule for if a company was at a good price was if their forward revenue growth was at their current PE ratio multiple. So 30 PE, 30% revenue growth, that's a fair deal. And that's exactly where we see Shift4. Completely kind of forgotten. It's a more boring company. They just process payments for, stadiums. They process payments for restaurants, that kind of thing. So, they're not the most exciting stock. And because of that, I believe that the market is drastically overlooking them right now. I believe they will continue excellent revenue growth even past their 3-year guidance. Maybe it will start to decline a little bit, but it will see massive revenue growth for years and years to come through their excellent M&A growth strategy. If you want to learn more about Shift4, make sure to watch my live stream where I did a massive 2-day deep dive into the stock. The next company I want to talk about is Fiverr. This is the original service marketplace. They are trading at near all-time lows in their stock price history. This company is priced as if they are going to be disappearing from the market. And that is because everyone's thinking, oh, all of these services can be replaced with AI agents, etc. I believe this is not the case. They've actually seen a massive uptrend in service providers of agentic automation setting up. So people who come into your company, they can set up AI automations for you and they sell that service on their platform. They've seen a massive increase in that. And I am a big believer that when a job is replaced through some kind of technology, it creates new types of jobs. So I just think there's so much potential for this company. And the big thing that really makes us think that this company is massively underpriced is their look-through PE ratio. So their enterprise value to look through PE, which is what we believe their terminal net margin could eventually get to, they are trading at a 5 PE ratio, look through PE ratio. So they are incredibly cheap to their potential earnings. They have not focused on profitability yet. They're still growing at a very, very respectable 10% annualized growth rate. And they haven't even started focusing on profitability yet. If they do that, it will become a very, very cheap stock very quickly. They're already shooting off tons of free cash flow. This company is definitely being overlooked in the market because of the massive excitement around AI. I don't believe Fiverr is going anywhere. Miha, the founder and CEO, is very focused on continuing to offer better services through their platform. They're even integrating AI for the service providers as well. They're doing a lot of exciting stuff over at Fiverr, and they are just being massively disrespected in the market right now. With their amazing gross margins, they can get to very high net margins, and they haven't even started focusing on that. They're still focused on growth. And so I think this is an excellent pick in a market that is at all-time highs. An honorable mention here, I just want to go over it quickly, is the Honest Company. We did a full deep dive where I said multiple times that is a very undervalued stock, and the stock price has not increased dramatically since then. In fact, I believe it's might be a little bit lower than when I did that overview. So if you want to learn about an additional undervalued stock, make sure to go watch our Honest video deep dive there. And for our fifth and final pick of undervalued stocks in a market that is at all-time highs is Mara. The reason we believe Mara is so cheap right now is because it is trading at a $5.8 billion market cap, and they are currently holding 52,477 Bitcoin. At the current market price of around $113,300 per Bitcoin, that means they have $5.9 billion of Bitcoin. So they are actually holding more Bitcoin than the entire market cap. So you can buy Mara stock right now, get more Bitcoin than if you went and bought Bitcoin on the open market, and get the entire mining company for free, in addition to all of their future products in sovereign AI data centers that they're working on right now. So this is an incredible deal. You literally buy more Bitcoin than what you pay for, and you get an entire Bitcoin mining company and an AI data center company for free. So Mara is an incredible buy right now. And that is why it is our fifth and final pick for 5 undervalued stocks in a market at all-time highs. So our 5 undervalued stocks is Lemonade. That's because they are growing revenue incredibly fast, potentially at around 100% over the next year. UiPath, you're buying the company cheap for the product they currently have, and they are coming out with a new groundbreaking competitive agentic automation platform called Maestro. You have Shift4, which is growing at 30% annually, trading at a 30 PE ratio. Fiverr, who's priced as if they're going to go out of business, trading at a 5 look-through PE. And lastly, Mara, who holds more Bitcoin than their total market cap. Thank you so much for sticking around to the end of the video. I hope you found this informational. This is for educational purposes only. This is not investment advice. Make sure to hit like and subscribe for more videos like this in the future. Have a great day.